Nidhi ma'am.
Ma'am, shall I start? Good afternoon. Hello. Am I audible? Technical team, am I audible? So good afternoon, everyone. So I, on behalf of Women and Young Members Excellence Committee, I welcome you all in this virtual series on Unleash Your Potential, Learn, Upskill, Excel. This series is one of the Women and Young Members Excellence Committee's initiatives to augment the knowledge and overall confidence building of the members presently working in industry, corporate, but aiming to switch to practice, members who are on career break but want to resume their professional career, or members aiming to widen their area of expertise in respective professional domains. This series will also be helpful for members at large in enriching their knowledge and overall confidence building by keeping them abreast with the latest amendments in diversified fields. Today we are going to cover session on basics of income tax, relevance of books of accounts under income tax, method of accounting, role of income computation, and disclosure standards and residential status. So for our today's session, we have with us C. Shivangi Samdhani. So now to introduce C.A. Shivangi Samdhani. She is a chartered accountant and is currently working as a partner in R. Sogani Associates, Jaipur. She handles income tax, litigation matters, and regularly appears before ITAT and CIT appeals for representing cases. Prior to working in Jaipur, she has worked with Deloitte Haskin Sells LLP, Mumbai, as an assistant manager in Stat Audit Department. She has presented papers at various forums like Women Empowerment Committee, Sky High Symposium, Doordarshan, Center of Excellence, Jaipur, branches of ICAI like Jaipur, Kishangarh, Chittorgarh, etc. She has a multifaceted personality, and apart from outstanding educational records, she is also the Visharad in Indian classical music and has keen interest in various other co-curricular activities. So this is all about the Shivangi Samdani. Now over to you, Shivangi.
Thank you, Nidhi ma'am, for such a humble introduction. At the
So
outset,
before Shivangi takes up, let me interact with all of you members for 2 minutes and welcome all of you friends to this series. And today we are starting with direct tax. We have completed GST sessions and friends, it is our endeavor to serve all of you the best. The series Unleash the Potential will cater all of you with the case study based learning and the vast exposure of the very experienced and the learned faculties. And from today, next 4 days, we are having this direct tax sessions. And I hope this will be a really very insightful and case study based learning, which will definitely make you enrich with the knowledge and as well as the experience. With these words, I welcome my dear speaker, CA Shivangi Samdani. I know she is doing very well at Jaipur. I met her and she is doing wonderful work, even being at Jaipur. So welcome, Shivangi. And I also welcome Aniti and Ragini, both the moderators. They are also from our fraternity and they are part of managing committee members of our branches of institute. And our secretary and the department, Shanu and Ruchi, they are doing wonderful work. And all my wonderful, intelligent women participants, once again, welcome all of you and wish you a very, very fantastic learning and wonderful and rich experience. Over to you, Shivangi.
Thank you, ma'am. Honorable Preeti Savla, ma'am, Nidhi ji, Ragini ji, program coordinators, office bearers, WIMEC. At the outset, I would like to extend my heartfelt thanks to Preeti Savla ma'am and this committee who have given me this opportunity to express my views and take the first session of these virtual direct tax series, Unleash Your Potential, Learn, Upskill, Excel. So I will just quickly share my PPT and then we can get started with the presentation. Is my PPT visible? Is it shifting? So the topic which is allocated to me is basics of income tax. And I would like to share with all that income tax is a vast subject, old subject. And this program, these virtual series are designed in such a way that everybody will get an exposure of what income tax is. If somebody is planning to enter into practice, this is the best series, I must say, because the program is scheduled and designed in such a nice way. So friends, starting with the history of tax. Is tax an old subject or is it a new thing? I know you will be amused to know that taxation is a very old concept. It is there from emperor's times. And I got to know that Kalidas, ages back, he gave a quotation, which I got in translation, which is mentioned in my PPT also. I would like to read it. It was only for the good of his subjects that he collected taxes from them, just as the sun draws moisture from the earth to give it back 1,000 folds. So yes, friends, taxation is from emperor's times, and it is that old that even Manusmriti and Ardhashastra are having traces of taxation. It is said that Manu suggested the king that as per Shastra, he can collect taxation. Although the taxation should be such that they don't pinch the pocket of the taxpayers, but they also help the king to run the empire. It is said that Kautilya in Arthashastra, he discussed a lot about taxation, financial planning, financial matters. And Arthashastra is known to be the first administrative tax on public finance, administration, and fiscal law of the country. So this concept is a very old concept and it is continuing till date. Taxes from those ages are being collected in two ways: direct tax and indirect tax. Direct tax is one which is collected directly from the person, and it is to be paid directly by that person to the government. Whereas indirect tax is imposed on goods or services and it is paid to the government, however, through a third party. And so both the concepts are old concepts, direct tax and indirect tax. Since our topic is with regards to direct tax, we'll be discussing the history of income tax first. To discuss the current income tax, we should know the background of income tax. In 1860, James Wilson, British ruler, he introduced income tax to meet the expenses and the losses which the empire suffered because of the first freedom movement, 1857. So in 1860, income tax was introduced. It got formalized by way of Income Tax Act first in 1922. So 1922 Act was the first Income Tax Act, and the basics of income tax which were laid down in 1922 are still continuing. However, I should acknowledge this thing that only the broad outline remained the same. The new act, which is 1961 Act, it is completely different than what 1922 Act was because of the rapid changes which are taking place. So after 1922, there was need of various amendments which were incorporated in 1961 Act. And this 1961 Act is being amended year on year, and it is never ending process. Amendment is a never ending process if I talk about income tax or for that matter, any other tax. So for example, in 1991, when globalization happened, India realized that the provisions of transfer pricing are needed. People are opening their companies in India, outside India, managing the affairs in such a way that base is shifted. The tax is paid in the country which is having either no tax or a very low tax rates. So provisions of transfer pricing were introduced. Thereafter, in 2004, provisions of annual information return were introduced to capture high value transactions. We have heard of direct tax code. It has been introduced, proposed twice, but it is not adopted till date. So year on year, amendments are taking place in income tax. And this is the best part about income tax, that it is never too late to begin the practice of income tax. Everybody who is in the practice is required to study income tax again and again. So it's never, too late to get into the practice. Income tax, I should mention here that income tax is having traces under the Constitution also. Our Constitution provides that income tax is to be collected by the central government. Article 270 of the Constitution, it provides that tax can be collected except on agriculture income. Then we have Article 265, which provides that no tax can be collected without authority of law. And accordingly, in the union list at entry number 82, it is provided that central government will collect income tax. It is not like GST or any other tax which is to be shared between the state or central government. Income tax is a central levy which is collected by central government. Now, today I am asked to cover the basics of income tax. My topic is basics of income tax, and I'll try to help you all out with the basics of income tax so that in the subsequent sessions you can appreciate the law in a better way, because the program is designed in such a way that you will be dealing with specific provisions of various topics under income tax. So I have divided my discussion into three parts. We'll understand law a little. we will understand that income tax is a self-evaluation and self-disclosure concept, and what is the procedure to go about it. And we'll discuss a little about assessments and litigations also. So starting with the law, which is the income tax law. Income tax law is a huge, vast subject. It is having 298 sections, 23 chapters, 14 schedules. And trust me, friends, actually the sections and chapters are more than what I have written, because the numbering in income tax, it takes place like 10, 10A, 10IA. So the last section, which is available on the statute, is 298. But the sections are more than that. And likewise, chapters also. We have chapter 6, then chapter 6A. So it is a huge, vast subject which one needs to understand. Accordingly, one can practice income tax. And along with these sections, chapters, schedules, and the rules which are in place, Income Tax Rules 1961, government, CBDT, they help us with various circulars and notifications times and again. There is ambiguity about lot many things when a new amendment is proposed. Like if you remember section 194R, which is TDS on perquisites of business and profession, it is a widely discussed topic. Lot many confusions were there. And thereafter, CBDT helped with a circular and provided for various FAQs to deal with section 194R. So apart from sections, chapters, we have for our help circulars and notifications, which time and again are introduced, which help assessees to build clarity, which helps we chartered accountants to practice income tax and suggest our clients. Likewise, judicial precedents also play an important role when we talk about income tax or any other law for that matter. Courts, various courts, High Court, Supreme Court, ITAT, they don't write law. What they do, they interpret law in its true sense. What is written, they help us to read it that way. And Article 141 of Constitution of India provides that decision of Supreme Court is law of land. So Supreme Court's decision is to be followed by everybody. Thereafter, in that streak, we have High Court. High Court's decision, if we talk about the jurisdictional High Court, as in I am from Jaipur, Rajasthan High Court is my jurisdictional High Court. And whatever decision Rajasthan High Court gives, it will have a binding force on all the assessees in Rajasthan. The decisions of other high courts will have persuasive binding force. It will not be 100% binding. We can refer it, but if Rajasthan High Court says otherwise, then it will prevail. Likewise, the decisions of Jaipur IT-80 would be binding on all the assessees who fall under the IT-80 Jaipur jurisdiction. So this judicial precedence criteria is there, the binding force is there, so that the law can be read properly, there can be consistency, there is judicial discipline, people don't get confused as to what to do next. So this also helps assessees, chartered accountants, and everybody to understand income tax. So it's a big law. And in bits and pieces, in this virtual series, you will be understanding various provisions of income tax law. And like I mentioned earlier, income tax law is changing, it is evolving, it is getting amended every day, every year. We all know that on 1st February of every year, finance minister comes out with a finance bill. Lot many amendments are proposed in the bill. When those amendments get a go-ahead from both the houses of parliament and president, it becomes Finance Act and it merges with the Income Tax Act. And there is a reason of bringing amendments. There were days, maybe our parents or grandparents, they could not think of anything like cryptocurrency, that what is cryptocurrency? They could not think of it. They could not think that sitting at home playing games can lead to revenue. They could not think of a digital economy, which is very prevalent these days. So, with the changes in trade, commerce, industry, finance, with the increasing facets of industry, social relationship, there is need of bringing changes under the Income Tax Act so as to equip the act to cover all the possible transactions and to bring under the net of income tax all the transactions. So accordingly, this keeps on amending all 298 sections, chapters, what we have discussed, all undergoes amendments every year selectively. So let's start with, in this background, let's start with the topic income tax. So we can say it is tax on income, and it is actually tax on income only. I will like to start it with section 4. Section 4 is charge of income tax section. It is the main section which leads to charging of tax on income. So as per this section, every person has to pay tax at prescribed rates on the total income earned during the previous year. Now we'll quickly, in brief, discuss what is meant by person, tax, and income. So I'll start with person. Person is defined under income tax, and it includes individuals, HUF, company, AOP, BOI, whether incorporated or not. And, all types of assessees are covered, which means everybody is required to pay tax. And it's an inclusive definition, so everybody is required to pay tax. The second important thing which requires attention of everybody is residential status. Residential status is important to understand because it determines the incidence of tax. It helps us to understand what is the scope of income of a person. So I want to emphasize here that person can be further classified on the basis of their residential status. And the distinction between their residential status is very important because what will be the amount of tax they are required to pay or what is the scope of income, it depends upon their residential status. And here section 5 and section 6, they help us. Now, what is contained in these sections? These sections cover individuals, HUF, firm, AOP, company, all type of persons. I'm starting with individuals. So section 6.1, 1A and 6.6, they provide that who will be known as resident. Resident, as we all know, is a person who stays in India. It is not restricted to citizen of India or person of Indian origin. We need to understand with regards to the definition which is provided under the income tax law. We'll very broadly discuss the concepts of residential status because residential status in itself is a big topic which requires a lot of deliberation. But just for the sake of understanding the basic issues so that you can think of entering into the income tax practice, let's touch upon the basics of residential status. So a person who stays in India for more than 182 days in a particular year is called resident. And friends, every year residential status is required to be checked because residential status is dependent upon the days or the conduct or decision making, and which can change every year. So every year for every person, residential status is required to be again determined. So as we were discussing, if we talk about individuals, any person who stays for more than 182 days in India in a year, that person is known as resident in that particular year. There is one more condition, which is alternative condition, which says that if a person is not there in India for 182 days, but was in India for 60 days, plus in 4 preceding previous years, he has spent more than 365 days, then also he'll be known as a resident. So there are two conditions. They are alternate conditions. If one is fulfilled, then a person will be known as resident. So if a person lives for more than 182 days in India, stays for more than 182 days in India, then he is resident. If not 182 days, but 60 or more days, then we'll have to check for preceding 4 previous years also. And just in case he has spent more than 365 days in those years, then also he's resident. There are a few relaxations provided for the people who are leaving India for employment, people who are of Indian origin or who are citizens of India, or for that matter, who are tourists who are visiting India for some time, and the persons of crew members of ship. So there are a few relaxations available for those persons also. So once a person becomes resident, his global income is to be offered for taxation in India. What I mean by global income here is that the income which is earned in India, as well as income which is earned outside India, which means the income which accrues, arises in India, or which is deemed to accrue, arise in India, the income which is received or receivable in India, the income which is deemed to be received in India, the income which is accrued, arises, which is received outside India, is also to be offered for tax in India. For example, I am a resident. I'm working here in Jaipur. I am practicing a profession. So I have a PGBP income in India, and I am also having a residential property in US where I earn rental income on that residential property. So since I'm citizen plus resident in India, I will have to offer for tax this PGBP income as well as rental income from US. So this is the treatment of residents. Now, if a person is resident, then we should also check for another condition. Before offering global income for taxation, there is another concept of not ordinary resident. So only if a person qualifies for the definition of resident, then not ordinary resident definition one has to see. Now, who are not ordinary residents? So basically, this NOR concept exists only for individuals and HUFs. It is not for companies or any other. It is not for companies or any other person. This NOR concept is provided as a relaxation for transitional period. You know, a person who is wanting to settle in India, who was non-resident earlier. So this is basically the relaxation for those type of individuals. So it sets out, NOR, it sets out that a person who was non-resident in 9 out of 10 previous years, that person is NOR. Or a person who has spent less than 729 days in preceding 7 years is also a NOR. Now, what is the difference between resident and NOR? We understood that there is, difference in the number of days they have stayed, but that is not all. The reason we need to understand the difference is whether to offer for tax global income or whether to offer for tax only Indian income and the income which is arising outside India, but from a business which is set up in India. So the scope of income of resident and not ordinary resident is different, which is why we need to understand if a person is resident, whether he is NOR or he is a normal ordinary resident. So in case of NOR, only Indian income is to be offered for taxation, and the income which although arises outside India, but is from a business which is set up in India, is also to be offered for taxation. Non-resident is the third category. This third category is simple. A person who is not a resident is a non-resident. So this is very simple. And in case of non-resident, only Indian income is to be offered for taxation. The government is not wanting non-residents to pay tax on their entire global income in India. They have this relaxation. Now, some amendments were introduced in Section 6 which are applicable from assessment year 21-22, and they were, discussed a lot. You must have read in the newspapers that certain conditions with regards to the citizens of India or persons of Indian origin, there is, a stringent provision which has come into picture, etc., etc. So that provision is very simple. That provision is basically for NOR. It says that a person who is not offering for tax his income anywhere in the world because of his domicile, but he is a person of Indian origin, then he'll be considered as an NOR in India, and he'll be required to pay tax on Indian income and the income which is accruing outside India, but from the business in India. And the persons who are citizen of India and people of Indian origin whose income is more than 15 lakh, Indian income is more than 15 lakh, and they have stayed in India for more than 120 days, are also NOR, and they are liable to pay more tax in India. So amendment with regards to NOR came into the picture, which we need to understand now onwards. I know this is a lot of calculation which one cannot understand virtually in this way, but yeah, this is the concept. And what I want to emphasize over here is that the scope of income of resident, non-resident, and not ordinary resident is different, which can be seen on the screen. There are a few other issues with regards to stay, like the stay need not to be continuous stay, that straight 182 days together. No, it's not like that. If a person comes in India, leaves India, again comes in India, again leaves India, if the aggregate stays more than 182, 120, 60, whatever number of days we discussed, if the aggregate number of days exceeds, then accordingly the distinction will be made. Plus the date of entry and date of exit, both are to be included. So this is one important thing which creates a confusion in minds of a lot of people. So this is one thing. There is one more distinction. So apart from offering income for taxation, there is one more issue. ITR forms which are required to be filled, they contain details with regards to foreign assets. So only residents are required to disclose all their foreign assets. Non-residents or NORs are not required to disclose their foreign assets to the Indian taxation authorities. So this was for individuals. Now we go on to HUF. The scope, it's the same. As you can see, the table is same. The only difference is individual is a person. So, one can calculate the stay. But in case of HUF, it is not driven by just the calculation of number of days of stay. It is more dependent upon control and management of HUF. So if control and management is situated wholly outside India, then the HUF is a non-resident. But if it is partly in India, partly outside India, or fully in India, then the HUF is resident HUF. And accordingly, the provisions of Section 5 and Section 6 would apply. HUFs can also be not ordinary resident, and as we have discussed that not ordinary resident, there is requirement of checking number of days. So those days requirements and implications will be checked upon the Karta of HUF, and accordingly it will be decided whether the HUF is a resident HUF or a non-resident HUF. If we talk about firm, AOP, and other type of persons, then there are only two categories, residents and non-residents. If control management is in India, partly in India, then it is resident. If it is wholly outside India, then it is non-resident. And again, if resident, global income is to be offered for tax, all the foreign assets, including the foreign interest, are to be disclosed in the ITR form. If non-resident, then just tax is to be paid on the Indian income and no further disclosure is required. Talking about residential status of company, again, it is a widely discussed topic. Companies can also be bifurcated into two, resident and non-resident. The condition remains same with regards to the scope of income. how we can understand that company is resident or non-resident, there are two conditions. Number one, if it is Indian company, then 100% it is a resident. A company which is incorporated in India is a resident company, no matter what. But a company which is a foreign company, however, is having place of effective management in India, then also it is a resident company. Now, this concept of POEM is a very much discussed concept. There are a lot of issues in and around POEM, and the tax authorities understood that people are managing their affairs, which is why they came out with this POEM concept. POEM is defined as place where key management and commercial decisions that are necessary for the conduct of business of an entity as a whole in substance made. Now, this means let's break this definition. So, place is the geographical location. What is the geographical location of the decision-making place? Key management. With key, we understand that key is vital. Management is board. So the place where the key management takes commercial decisions, commercial business related decisions, which are necessary for conduct of business, in substance, as in totality, are made. So if a foreign company is incorporated outside India, of course, it's a foreign company incorporated outside India, and the major decision making happens in India, only the minutes of board, they are written outside India, or signatures happen outside India, then also it will be an Indian company only. And the moment it becomes, resident company, the moment it becomes resident company, the global income is to be offered for taxation. Now, there can be a situation, so as we have discussed, that all the persons can be bifurcated based on their residential status. There can arise a situation wherein a person is required to pay tax in more than one country. Like I gave my example, I am based out of Jaipur. I am having professional income in Jaipur, and I am owning a house property in US also. US tax authorities are also charging tax on that rental income. Being resident in India, I am paying tax on my professional income as well as the income which is earned in US. So now on rental income, I am ending up paying tax in India as well as outside India. So this is hitting my pocket a lot, So the government is mindful of this fact, and there are double taxation avoidance agreements of India with many countries. And as per the provisions of Section 90 and 91, foreign tax credit is allowed. What I will have to do, I will have to file Form 67. I will have to write the particulars with regards to my income in US, and I will have to furnish proof that I've paid tax in US. So when I'll calculate my tax in India on the same income, I'll get some deduction based on the provisions what are provided in DTAA. I will get deduction of the tax paid in US while I'll pay tax in India. So whatever tax I paid in US, I will get credit of the same to a certain extent in India while offering my global income for taxation in India. So this covers my discussion with regards to persons. So the first line item which I mentioned in section 4 is every person. So now we understand that all sort of persons are covered under the definition of person, and the persons are to be further bifurcated based on their residential status so as to ascertain their tax liability and their scope of income. Coming on to the next line item of section 4 is every person is required to pay tax on prescribed rates. Now, tax is to be paid on prescribed rates. What is meant by prescribed rates? I think everybody knows that first schedule of Finance Act provides for tax rates, slab rates for individuals, HUF, association of persons, body corporate, there are flat rates for firms, companies, etc. So what is required to be seen is first schedule of the Finance Act, which will guide for the tax rates. Also, I should mention here that the tax rates for residents and non-residents are also different. So we'll have to refer the first schedule while calculating the tax. Not only just first schedule, we'll also have to refer to various provisions of Income Tax Act, specifically Chapter 12, which contains special rate of taxation. Special rate of taxation, for example, we all know that for individuals, there is a new regime of taxation, different slab rates that is provided under Section 115 BAC. So this 115 BAC is contained in Income Tax Act under Chapter 12. So while calculating tax, we will have to see Section 115 BAC. If the total income contains income under the head capital gain, then also we need to see that Section 112, Section 112A of the Income Tax Act provides for tax rate with regards to capital gains. Is my PPT visible? Sorry. Hello? Yeah, sorry, there is a technical glitch at my end, I believe. I just stop share and restart again. Sorry. Yeah, is it visible? Tax on prescribed rates. Okay, thank you. So yeah, we also need to see the provisions of Income Tax Act. If I talk about trust and a trust is in receipt of anonymous donation, then provisions of Section 115 BAC would apply. The rates prescribed therein would be considered for calculation of tax. Likewise, we know that there is a shift in the rates of companies. The companies are now allowed subsidized rates 22%, 25%, 15%. All those are contained under Section 115. So to understand what are the prescribed rates, we need to see the provisions of income tax, specifically Chapter 12, as well as the Finance Act first schedule. So from there, we'll get to know what is the rate of tax and how it is to be calculated. After understanding what are the rates of tax, tax is to be computed in case of every person, and the tax due is to be paid to the government. Now, I would like to mention here only that there are various rebate provisions also under the income tax law. For example, Section 87A, we must have heard that the income up to 5 lakh is not taxable. It's not so. The slab rate starts from 2,50,000. Because of the rebate which is provided under Section 87A, the tax which is paid up till income of 5 lakh becomes zero, because there the rebate of 12,500 is provided. So there are certain rebate provisions also which are required to be considered. Also, TDS and TCS is also required to be considered over here, because one gets credit of it. Now, what is meant by TDS and TCS? TDS is tax deducted at source and TCS is tax collected at source. It is a concept which is introduced by the government to capture more and more transactions which otherwise would escape from the tax net. So what happens? A person, before making payment to somebody, has to deduct TDS and deposit the same with the government. So for example, I'm a chartered accountant, I'm a professional, I'm rendering services of say 1 lakh rupees to Mr. A. Now what will Mr. A do? He will not give me 1 lakh rupees. He will give me 90,000. He will deduct 10,000 rupees as per Section 194J. He will deposit 10,000 with the government on my behalf. So this way, government will know that I earned income of 1 lakh. So 90,000 I received in my pocket, 10,000 reached to government. So while paying taxes on my total income, I will get deduction of that 10,000. So this way, tax is to be calculated and is required to be paid. Moving to the third line item of section 4. So now I am trying to make you revise that we discussed 2 line items, that every person is required to pay tax at a prescribed rate on the income which is earned during the previous year. Now, discussing the third issue, which is income. Income is actually defined under Income Tax Act under section 224, but the definition is inclusive definition. And why is it inclusive definition? Because word income is of elastic import. It is to be construed in the widest possible manner. Till date, no legislator, no court, no economist has attempted to exhaustively define what is income. So we need to construe it in the most widest possible manner. And there is reason also, as we discussed. The dynamics of trade, commerce, business are changing rapidly every day. Digital economy is there. Cryptocurrency is the new basically. So if we think that 1961 definition of income would suffice, it cannot be that case. So every year, definition of income is enlarged. Many new line items, many new transactions are included in the definition of income. So right now there are 33 clauses, as in the 33 type of transactions are said to be income in the inclusive definition. And income should not be restricted just to the profits. It's not so. If we understand in simple terms, income basically is return. So by return, I mean it is a fruit of a tree or crop of a field. And income is a return in monetary terms, whether received as money or in kind, measurable, which is from a definite source and which is received periodically or is expected to be received periodically. So income basically in layman's terms is a return on any transaction. So we need to understand what is income to calculate the tax. And there is a lot of guidance available under the income tax law to understand what is income. We will also touch upon a few concepts of income. Because of the paucity of time, we cannot discuss a lot of issues, but yeah, I have selected a few which I thought would be important for today's discussion. The first concept which I want to talk about is accrual. If we know, Income Tax Act revolves around accrual. Accrual means right to receive in simple terms. So when an income accrues, it is to be offered, it is required to be offered for taxation. And accrual can be understood with the help of decision of Supreme Court in case of Excel Industries. It is a landmark decision. And Supreme Court laid down 3 tests which are helping the chartered accountants and assessees till date how to understand whether income has accrued or not. So what happened? Excel Industries, they made export of some of their goods and they received export incentive. Export incentive was such that after making export, they will get duty-free import of raw material. So there was some calculation around it. In simple terms, when you make export of goods, you will get raw material without paying duty. So that was the scenario over there. So Excel Industries made export in year 1 and they became eligible to import raw material without paying any duty. So in year 2, they imported the raw material without paying any duty. Excel Industry was smart enough to understand that in year 1, no income per se is there. Basically, when incentive is received from the government, it is the income of assessee. So whatever duty benefit assessee received, that is to be offered for income, that is to be offered for taxation. So what Excel Industry did, they did not offer that export incentive for tax in year one. They said that we became eligible to get incentive, but the incentive can be converted, can be realized only when we do imports. So twin conditions are to be satisfied. First making export and then making import, then only incentive would be received. So in year one, they did not offer for tax incentive. In year two, after making import, they included in their income the export incentive received. Assessing officer was of a different view. He was of the view that in year one only, Excel Industry is required to pay tax on the export incentive. Now, what Supreme Court said? Supreme Court laid down 3 tests. Supreme Court said that first, what is to be considered is that only real income can be brought to tax, not hypothetical income. So when will assessee have income of export incentive? Only after satisfaction of both the conditions of making export and making import. So in year one, the income would be hypothetical that in future, the assessee would receive this incentive. What if they don't make import? The condition would not fulfill and it will remain to be a hypothetical income. So this was first test, that only real income can be offered for tax and not notional income. Second test was when a person gets a right to receive from any other person, then the second person should also have the obligation to make payment. So Excel Industries, after making export, got a right to receive export incentive. But the government was not having any obligation to make payment of that export incentive because till year one, no import of raw material took place. So for income to accrue, there has to be a right to receive, simultaneously corresponding liability or obligation to pay. So this was the second test. And third test is possibility of realization. So in year one, since no imports are made, there can be no possibility of realization of export incentive. Possibility arise only in second year. So because of these 3 tests, I'm repeating the 3 tests. Number 1, the income should be real income, not hypothetical income. Number 2, with the right to receive, there has to be a corresponding obligation to pay. And number 3, probability of realization should exist. Then only income would be said to accrue. So for every transaction, we need to apply these 3 tests. And once we decide that, yes, income has accrued, then only it will be considered as part of total income. So this is the first, and I should say it's a fundamental concept of income. Accrual, without accrual, no income can be taxed, basically. Other concepts of income, what I have selected, I will be starting with the first, capital receipt versus revenue receipt. So it is said by various courts that only revenue receipts can be brought to tax and not capital receipt. Now, what are capital receipts and what are revenue receipts? There is a lot, huge literature available to make you understand this, but I'm cutting long story short. Whatever hits the capital apparatus of the company or any entity is a capital receipt. And whatever is, revenue in nature, trading, regular, that is revenue receipt. So, for example, my capital asset, say I have made some investment. So that is my capital asset. I have invested my capital in investment. So that is my capital. If I'm selling my investment, then I'm just changing the form of my capital. From capital, it became investment. And now when I'm selling it, I'm realizing, say, cash or my bank balance is getting increased. So only form is changed. It still remains capital. So whatever the receipt is a capital receipt. The only difference would be, little appreciation or depreciation in the value of my investment, but it would remain capital. So the receipt from sale of investment is capital receipt. Now you must be thinking that sale of capital asset is liable for tax. Yes, friends. Sale of capital asset is liable for tax. In spite of the fact that it is a capital receipt, the scope of income is enlarged. Specifically, under clause 6 of 224, it is provided that income from capital gain is income. Basically, capital gains are part of income. So before this amendment, whatever receipt were made with regards to sale of investment, they were capital receipts and were not required to be offered for taxation. In the same way, if I discuss some case law, Reliance Industries, Bombay High Court case law, Reliance Industries Limited, wherein Reliance Industries, it received subsidy from the government because some industry was set up in the backward area. So, backward area were promoted, there was development, industrial development over there, employment boost was there. So government provided a subsidy. And since this subsidy had nothing to do with day-to-day income and expenditure, it was a capital subsidy. And accordingly, it was held in those days that this is a capital receipt and this is not part of income. But now, friends, even this receipt of subsidy is specifically added in the definition of income. Clause 18 of the definition provides that any type of grant received from government is to be offered as income. So it is a capital receipt, but because of enlarged definition of income, it is part of income. Delhi High Court, in one of its decision, Pawa Industries Private Limited, got a chance to deliberate upon one of the issues. In that case, a company was conducting business on a particular land. That land was taken on lease. And before the expiry of lease period, the landowner asked Pawa Infrastructure Private Limited to vacate the land. And that Pawa Infrastructure was compensated because of breach of condition of lease. So this receipt, what Pawa Infrastructure Private Limited received, is held as capital receipt in the hands of Pawa Infrastructure Private Limited by Delhi High Court. Why? Because the land was used for the purpose of business. That was, the profit-making apparatus of the company. And the moment that land is taken away and the assessee is compensated, then it is a capital receipt. And thankfully, till date, no such amendment has come which enlarged the scope of income to that extent. So I could lay hands on this example to establish that even capital receipts are there which are not taxed. Gifts are also capital receipts. They are not liable for taxation per se, but because of enlarged definition clauses 17 onwards, they provide for taxation of gifts as income. So likewise, over the years, many capital receipts are brought to TaxNet, and accordingly, in spite of the fact that they are capital receipts, they are to be included in the total income of the assessee. So this is one concept we need to understand after whether income has accrued or not, that whether it is capital receipt or revenue receipt. Revenue receipt, yes, to be offered for taxation. Capital receipt, we'll have to check whether it is included in the definition of income. If yes, offer for tax. If no, don't offer it for tax. So this is the second concept. Third concept, which I thought of discussing, is exempt income. So there are certain incomes, there are certain receipts or revenue which are actually income, but by virtue of specific provisions of the Act, they are exempted. And Section 10 is full of this exempt income. There are agriculture income is the classic example. Agriculture income is income, one makes profit out of it. It is a return, it is periodic, it is from definite source. So it qualifies the definition of income. But since it is specifically provided under Section 10, it is exempt from taxation. So we also need to understand whether this particular income, the moment we conclude that yes, this transaction has resulted into income, we need to check Section 10 whether it is exempt from taxation or it is liable for taxation. Next, we can discuss for real income, which I briefly discussed while discussing Excel Industries. Basically, only real income can be brought to tax and not notional income or hypothetical income. For example, a company extended an interest-free unsecured loan to one of its subsidiary companies. Now, since the loan is interest-free loan, there can be no income on interest income on that loan. So if a person comes and says that you have given loan, there will be interest income. And if the other person is made to understand that, see, this is interest-free income, interest-free loan, then it is clear that there is no real income. Hypothetical income cannot be brought to tax. The income has to be real income, then only it can be brought to tax net, otherwise not. And another example, what we can discuss here is concept of mutuality. It is a very settled proposition that no person can make profit from himself. I, practicing my profession, helping myself out, cannot make profit from myself. This is a very prevalent and settled concept. So mutuality is the concept which works on this principle only. We know many organizations wherein, people, they come together, they have common interest, they contribute some amount, and then that amount is used for benefit of all. So it is like a person has spent for his own benefit. So their concept of mutuality comes into the picture, and it is said that no person can make profit from oneself. So if there is association of person, say chartered accountants have come together, that they'll run a study circle, and every chartered accountant, they contribute as membership fees, rupees so and so every year. And with that money, they, organize various events of learning, they call speakers. So for their benefit, they have contributed. So their concept of mutuality will come into the picture. And it is said that under mutuality concept, no income can accrue or arise. So any income which is calculated over there will be a hypothetical or notional income. No real income would be there. Accordingly, no tax can be levied on the same. So only real income is to be put to tax and not hypothetical or notional income. There is another concept. For income, I have considered this to be the last concept in the discussion, which is deemed income. So there are various provisions under Income Tax Act wherein deeming principles, deeming fiction, they come into picture. And all these are anti-abuse provisions. So, for example, we know that real estate sector is a undervalued sector and one can manipulate it very easily. And the legislator understood that people are manipulating their transactions. So what they said that whatever amount you sell your property at whatever amount, we will consider the circle rate or DLC rate or the rate which is computed by the stamp valuation authorities to be the fair value of consideration. That will be considered as the sale consideration, and accordingly income would be computed. So there can be a scenario that as per the conveyance deed, some lesser amount is written in the deed. And assessee says that say I received 900 rupees only for selling a land, but the circle rate of land is 1,000 rupees. So there, income tax would ask us or the assessees to replace 90 from 1,000. And using 1,000 income would be calculated. So there are many deeming fictions available under the Act. Section 50C I discussed, sale of property, which is a capital asset. Likewise, there is Section 43CA, which is applicable on stock in trade. So when immovable property being stock in trade is sold, then again, its circle rate, DLC rate is to be considered. There is deeming fiction with regards to deemed rent. If an assessee is owning more than one or two allowed self-occupied properties, then for all the other properties, it would be deemed that they are given on rent. So deemed rental income would be asked to offer for taxation. So the incomes which the assessee is not disclosing, still because of deeming fiction, they would be liable to pay tax on the same. So with this, I have discussed 5 concepts of income: accrual, capital receipt, revenue receipt, exempt income, real income, and deemed income. There are other concepts also available, but I'm restricting my discussion on these 5 issues, which I thought are very important to understand before moving ahead with, these virtual series. Now, income has to be bifurcated under various heads. So now we understand that tax on total income is to be paid by every person. Now, we have blurred understanding of what income is. Now, this income is to be further bifurcated into various heads, and accordingly, total income is to be computed. Now, these heads of income are provided under Section 14. We know 4 heads: salary, house property, PGBP, capital gain, income from other sources. Why this distinction is needed? Because every head is having a unique way of computation of income and is also having different rates of taxation for that particular head. So a distinction, a bifurcation under heads of income is required. In fact, the ITR forms are also designed in such a way that one needs to bifurcate the total income into various heads of income and then only offer tax. So now we understand that every person is required to pay tax on the total income which is earned by him during the year at prescribed rates. Now, year runs 365 days, and every day there can be a transaction. There can be n number of transactions in a day. So what helps us? What comes to the rescue? Books of accounts. Books of accounts are the basis of computation of income. That is the way people, manage their affairs. So books of accounts play an important role. And under income tax also, books of accounts play a really important role. Books of accounts are defined under Section 212A. It covers ledgers, day books, cash books, etc. Whether maintained physically or maintained as printout of electromagnetic storage devices. And now from Finance Act 22, we also know that books can be maintained digitally. So basically, ledger accounts, the financial accounts, what we make, books of accounts, are the books of accounts which are mentioned under income tax also. Now, books of accounts, again, can be conclusive and decisive and cannot be conclusive and decisive. So the Income Tax Act, it makes a distinction. So for the purpose of a few sections, books are conclusive and decisive. Whatever is written in the books is to be accepted by the assessing officers or any appellate authority. No change can be made. For example, if we talk about the provisions of MAT, Minimum Alternate Tax, which is contained under Section 115JB, their book profits are to be computed. And how book profits are computed? There are, additions and deletions, adjustments provided under 115JB explanations. But the adjustments are to be applied at the net profit as per books of accounts. So there, while calculating book profits as per MAT, whatever net profit is there in books of accounts is conclusive and decisive. Assessing officer will have to start from that net profit and then make additions and deletions. So this is one example I can think of. Another example is bad debts written off, section 36(1)(7). It provides that when a bad debt is written off in the books of accounts, then deduction with regards to the same shall be allowed to the assessee. And assessee need not explain how it is not recoverable, etc., etc. What is the condition is it has to be written off in the books of accounts. So the moment a debt is written off as bad in the books of accounts, it becomes bad debts and allowable as deduction. So for bad debt deduction and for MAT, I could think of these two examples. Books are conclusive and decisive. But for all the provisions of the Act, we cannot say that books are conclusive and decisive. Supreme Court, in case of Kedarnath Jute Manufacturing Company Limited, held that books of accounts are not decisive. Entries in the books of accounts are not relevant. Books are cogent, but books are not decisive. Now, what Supreme Court wanted to say here is that when there is a specific provision otherwise providing, when there is a specific provision under Income Tax Act which provides otherwise, then that provision would prevail and not books of accounts. So when assessee maintains books as per the system of accounts, accounting standards, it must be correct. But if Income Tax Act provides otherwise, then what is to be seen for computing income is the Income Tax Act. There, the entries in books of accounts would not be decisive. Also, income tax holds the principle of substance over form. So the substance of every transaction is needed to be understood and not how it is presented. Very conveniently, we can, change the words and change the name of the ledgers for manipulating the transaction. We can think of many colorable devices. We can window dress the transaction, but the substance of the transaction would prevail if assessing officer is able to understand specifically what exactly happened. Then he will lift the wheel of form and he will make assessee liable for tax as per the substance of the transaction. So yeah, books are cogent, books are they help in guiding, but they are not decisive. Let us discuss a few examples as wherein we can say that yeah, books are not decisive. So first, I would like to touch upon section 145, which provides for method of accounting. So section 145 provides for method of accounting while computing income under the head PGBP and income from other sources. So it is not for salary, house property, and capital gain. It is relevant only for PGBP and income from other sources. I think that the subsequent speakers would be covering this issue in detail, but we'll briefly touch upon this topic, method of accounting. So two methods are prescribed. One is mercantile system of accounting and the other is cash system of accounting. Mercantile system, cash system, both are not defined under income tax, and we have to take guidance from the accounting principles only, that what is mercantile system and what is cash system. So we understand that accounting on due basis is mercantile system. So whenever a payment becomes due, irrespective of the fact whether it is paid or not in cash, still it is to be recorded in the books of accounts. So that is mercantile system. If we are eligible to receive some amount, irrespective of the fact whether it is received or not, then it is to be recorded in the books of accounts. So mercantile system keeps aside the change of hands basically through cash or through banking channel. So whatever is due is to be recorded as per mercantile system. And cash system, on a contrary, it covers or it provides for recording of transactions only on the basis of disbursement or receipts. When payment is made, record it. When payment is received, record it. Due, you need not record the same on due basis. Now, assessees are provided option to select between the two. Whether they want to select mercantile, they can select mercantile. Whether they want to select cash, they can select cash. Income tax officers would not question them. So the moment they select, it is finalized. So mercantile system and cash system are two systems which are provided under the Income Tax Act. There is a controversy around hybrid system of accounting, which provides for mercantile and cash. There are few decisions in favor, few against, but Section 145 is not providing for the same. So I'm not going into those details as of now. Now, Section 145, apart from providing for method of accounting, also provides for income computation and disclosure standards. Now, Section 145(2) basically provides that central government can notify income computation and disclosure standards. So, ICDS, we call it ICDS. ICDS are very important for computation of income. One cannot skip ICDS when it comes to income under the head business and profession and income under the head other sources. These are a must thing. And if I talk about the history of ICDS, then in 1996, government first time introduced two ICDSs. One was with regards to disclosure of accounting policy, and the other was disclosure of prior period extraordinary items and all. So there were two ICDS. Thereafter, in the year 2016, in the month of September, central government came out with 10 ICDS. And these 10 ICDS are applicable as on today. And these are very comprehensive. They basically, by way of these 10 ICDS, the government has tried to inculcate the accounting standards in the income tax law. And ICDS borrows guidance from accounting standards. They are very similar to accounting standards, but there are a few differences there. In that 2016 notification with regards to ICDS, one thing was made clear that ICDS would be applicable only on the persons who are following mercantile system of accounting. So the one who follows cash system of accounting is outside the ambit of ICDS. So only the people who are following mercantile system would have to apply ICDS. And whenever there is conflict between accounting standard and ICDS would prevail. Whenever there is conflict between ICDS and Income Tax Act would prevail. So this was written in the preamble of ICDS. Now, 10 ICDS covers 10 and odd accounting standards. These can be discussed in detail, and a specific session is required for discussing ICDS. I would like to just touch upon a few differences. Because we understand accounting standards more, it will be easier to understand difference between accounting standards and ICDS. Take my word, ICDS 90% are accounting standards. Only 10% differences are there, which one need to take care of. So for example, the concept of prudence is absent in ICDS. So what is the concept of prudence? That prudence is a concept which says that record the liability, even if it cannot be estimated properly, and defer the income unless and until there is a certainty of receiving the same. So this is the concept of prudence. It is accounting concept. Prudence is not defined under income tax. It is accounting concept, and accounting standards, they revolve around prudence. But ICDS has done away with prudence. They don't consider prudence at all. So there are various provisions which say that expected losses would not be recorded while computing income. So I think I missed on one point. ICDS are applicable only for mercantile system of accounting, and they are not for the purpose of maintaining books of accounts. They are only for the purpose of computation of income. So using books of accounts, adjustments on account of ICDS are required to be made. So if in the books of accounts, expected losses are booked, then while computing income, parallelly using ICDS, those expected losses are to be eliminated. So we see there are, every business is having some or the other expectation with regards to losses, and they provide for the same. ICDS says no. Prudence concept is not there, so expected losses cannot be recorded. Another thing which is different from accounting standards, which we can discuss, is valuation of inventory. Accounting standard 2, it covers valuation of inventory being raw material or finished goods. It is not providing any guidance with regards to valuation of inventory, which is in WIP stage, work in progress stage. But ICDS provides that no, work in progress is to be valued, and not only this, the valuation of service provided should also be made. AS2 contains valuation of inventory with regards to goods. ICDS 2, which is the corresponding ICDS for valuation of inventory, it provides that even the value of service provided would be calculated based on the labor charges of supervisor and overheads and etc. If we talk about construction contracts, accounting standard 7, it provides for two methods, percentage completion method and completed contract method. ICDS just provides for a percentage completion method, not for completed contract method. The service which are services which are rendered for less than 90 days, ICDS allow that they should be accounted for, they should be included in the income in one go. Need not bifurcate it over the period. 90 days is a small period. The moment the contract is complete, book it as income. So ICDS provides for that. ICDS also provides that when a service is to be provided, over a period of time, then straight line method can also be used. So this is also a difference. There is no accounting standard which covers valuation of stock in trade, which is securities. There is a specific ICDS 8, which provides that the securities which are held as stock in trade are to be restated at the year end category wise, as in not script wise, cost or NRV, whichever is lower. We'll club the category. We'll see total cost of the category, total NRV of the category, and then accordingly value it in the books. So likewise, there are a few more differences when we talk about accounting standards and ICDS. And trust me, it's a very beautiful subject to read. And when a company has adopted Ind AS, then the role of ICDS and Ind AS, it is really interesting to understand, because there are a lot of differences. As we know, accounting standard and Ind AS are different. AS and Ind AS, there are a lot of differences over there. Likewise, Ind AS and ICDS are also very different. So accordingly, one need to take care of ICDS while computing income under the head PGBP and income from other sources. Now, as I mentioned, that there are a few concepts which are done away under ICDS. So accordingly, when ICDSs were introduced, a lot of litigation happened, and Delhi High Court, in the case of Chamber of Tax Consultants versus Union of India, which is a landmark decision if we talk about ICDS, Delhi High Court struck down various provisions of ICDS, saying that it is not in the theme of income tax law. They said about a lot of things that it is overruling a settled principle which is laid down by Supreme Court, and various provisions were struck down. But what happened after the decision of Delhi High Court came, in the subsequent Finance Act, amendments were brought with retrospective effect. So whatever ICDS stand as introduced as on that day, even after the decision of Delhi High Court in case of CTC versus Union of India, it stays the same today because of various amendments under Income Tax Act. And to name a few, Section 145B, subsection 3 was introduced. It says that government grant is to be recorded when it is received, if not recorded earlier. So the income with regards to government grant cannot be deferred beyond the point it is received. Whereas accounting standard says that if all the conditions with regards to receipt of government grant are not fulfilled, one should not recognize government grant. Again, prudence concept prevails over there. ICDS absent of, there is no prudence over there. So they say once it is received, you cannot defer the recording of the same as income. So section came into the picture, and now one need to follow this particular thing. Talking about expected losses, mark-to-market losses, they are allowed to be booked under accounting standards, but they are not allowed to be booked under ICDS because of section 36(1)(18). Unless it is allowed under ICDS, no expected loss can be booked. So this was a brief about ICDS. Discussing further on specific provisions. So the background, what we started with is books of accounts, whether they are cogent. Yes, they are cogent, whether they're decisive or not. So we understand that books of accounts are decisive only at a few places. In all the other cases, one need to understand the specific provisions of the Act. Number one, what we discussed is method of accounting, mercantile, cash system. ICDS is also a part of method of accounting. Now, there are other provisions which I have picked up with regards to the law. So there is a section 43B, which is deduction on actual payment. 43B comes under PGBP head. It says that when a statutory liability is incurred, it will be allowed as deduction only when paid. So suppose I am employer and I am required to make payment of provident fund of the employees which I deducted earlier, then it becomes due as per the due dates of PF Act, which is 15th of the next month. But unless it is paid, it will not be allowed as deduction. Or we can say that GST. GST is a statutory liability. Again, it is incurred every day. GST though is incurred every day. So unless it is paid, it will not be allowed as deduction. So these provisions of section 43B, they uplift the system of mercantile accounting. So mercantile system says that, accounting is to be done on due basis and accordingly income is to be calculated. Now here, 43B, it just uplifts mercantile system. It says no. Specifically, we will see whether they are paid or not. Only if they are paid, then only deduction would be allowed. So there are a few provisions which provide for specific deduction, specific conditions which are to be taken care of while computing income. If I talk about the provisions of clubbing, section 64 is the section, and we have been reading that section from years. It says that income of spouse or income of daughter-in-law or income of minor child, it will be clubbed in the hands of the husband or guardian or whatever. So in books of accounts, since it is income of other person, it will be recorded in the books of other person. But here again, because of the provisions of clubbing, books will be kept aside. There will be an adjustment taking place in the books of accounts to incorporate the provisions of clubbing while computing income. There are various deductions under the Income Tax Act, and section 35 contain a few weighted deductions also. What they provide that you make a payment to so-and-so person, basically research organizations, and you get deduction of 150% of whatever you have paid. So again, you make payment of rupees 100, you get deduction of rupees 150. So in this case also, the books of accounts will be considered, but will not be decisive because of the specific provision under the Act. So what I want to emphasize upon here is that we now understand what is income, and income is offered for taxation. People use books of accounts as an aid to compute income, but books of accounts are not decisive. Just on the basis of books of accounts, income cannot be offered for taxation. We need to understand other provisions of the law to compute income in the correct manner. And this process of calculation of income is very, very important and time consuming. And this brings me to the next agenda of my today's topic. So we have covered the basic understanding of law. Now I would like to cover basic understanding with regards to the procedure of self-evaluation and self-declaration. So income tax law in India is not a law wherein, government calculates the tax liability. It is a law wherein the assessee is required to calculate the tax liability on his own and declare it himself. So the assessees, with the help of we chartered accountants, they're required to understand, okay, these are our incomes, under what heads they are incomes, then what is the total income, how much tax is to be paid. After all that exercise, a declaration is to be filed. And this declaration is in ITR forms. There are 7 ITR forms which are there present. These ITR forms are amended every year. So the way the law is evolving, the ITR forms are also amended so as to keep all the required particulars in ITR forms. So before, I think every year by end of March or start of April, new ITR forms are notified. And we need to see that what all is required to be reported therein. And I should tell you this thing that it not only asks for the heads of income and the computation of tax liability and the calculation of total income. It asks for additional information. Information like, if I talk about an individual will have to report that in which companies he is director in that particular year, in which companies he's shareholder in that particular year, what are his foreign assets, and so on and so forth. There are various extra information which are required to be declared therein. So if I talk about ITR forms, there are 7 ITR forms. First ITR form is Sahaj form. It is for individuals who are residents and whose total income is not exceeding 50 lakh rupees. And they should not be having capital gain income and PGBP income. So those people, they file Sahaj, and it's a very small form, 1-2 pager form, very simple form. Another form is ITR2. It is for individuals and HUFs who maybe are having income of more than 50 lakh, who are having income under the head capital gain also, but not PGBP. So basically the persons who are not having, individuals and HUFs who are not having PGBP income can file ITR2. ITR form 3 is for individuals and HUFs who are having income under the head profit and gains and professions. ITR 4 is for the persons who are opting for presumptive taxation regime. So there is presumptive taxation regime also available under the Income Tax Act, Section 44AD, 44ADA, 44AE. I am not discussing those presumptive taxation because they would be these topics will be covered under the head PGBP in the subsequent session of this virtual series. So for presumptive taxation, ITR 4 is required to be filed. Other assessees, other than individuals and HUFs, they are required to file Form ITR 5. But ITR 5 is not for companies and not for trusts in simple terms. Companies are required to file ITR 6, and trusts or political parties, they are required to file ITR 7. So different people, persons having different heads of incomes are required to file different forms. Selection of forms these days is very easy because everything is computer driven. The income tax return is to be filed online. So the feature which is provided on the income tax website, it is very easy, and it helps us to select the correct ITR form. But earlier, and in fact now, we should understand that filing return in correct ITR form is very important, and not just filing of return of income. Again, there are a few forms which are required to be filed along with return of income. So as we know, there is a new taxation regime for individuals, different rates of tax. We called it new regime. So for opting into new regime, as per section 115 BAC, one needs to file form 10 IE. Unless that form is filed, one cannot opt for the new regime. If a business is claiming deduction under section 80JJAA. 80JJAA is basically deduction with regards to employment. Again, it would be covered under PGBP or deduction section. So for that also, Form 10DA is required to be filed. If I want to take foreign tax credit as discussed earlier, then I have to file Form 67. So these forms are required to be filed as per their due dates, which are before the date of filing of return, due date of filing of return. So one needs to understand what is the income, what are the forms which are required to be filed, and then select a proper ITR form and then file the return. This appears to be very procedural, and because of this element of procedure, maybe many of you must not be having interest in this process, but trust me, friends, this is a way to capture the market. And if you master filing return of income, then there is no way back, because filing of return of income in today's day and age is the most difficult thing to do. When we practice litigation, it is easy. You have to restrict yourself to a few sections. This is the section, these way provisions are to be applied. But for filing your income tax return, you need to understand the entire income tax law, what we are discussing in brief during this session. So this is a very important step which should not be taken lightly by either assessees or the chartered accountants. This is very important because correct filing has its own relevance. As I discussed, ITR forms, there are different ITR forms. Correct ITR form is to be selected, without which correct income would not be offered. There is a concept of annual information return. This concept is an old concept, came in 2004, I believe. There is section 285BA under Income Tax Act. This was introduced to capture high value of transactions. So, different assessees are required to file Form SFT because of the provisions of section 285BA. And with those forms SFT, the information with regards to every assessee gets captured. For example, bank is required to file Form SFT, and bank is required to report the names of the persons, their PANs, who have deposited more than 10 lakh during the year. So if I have deposited 20 lakh during a particular year, my bank, under the obligation of reporting, will report it to the income tax department in Form SFT because of provisions of the act, and this information will become part of my AIR, annual information return. So when I'll file my return of income, the department would already be knowing that I have made deposit of more than 10 lakh rupees during the year. So they will scrutinize my return accordingly. Every company who is issuing shares, debentures, bonds of more than 10 lakh rupees to a person are required to report it. Again, their reporting would result into AIR. Mutual funds, they are also required to make reporting of the persons who have, in aggregate, contributed more than 10 lakh during the year. Every person who's required to get the books of accounts audited under Section 44AB, they are required to disclose that from whom they received more than 2 lakh rupees in cash during the year. So there are various persons, specified persons who are required to do a specified reporting. With the help of their reporting, Income Tax Department catches those persons who have made investment, who have deposited tax, who have paid cash, etc., etc. So that forms part of AIR information. And most discussed AIS and TIS from November 21, Government of India, they came out with the concept of AIS and TIS, Annual Information System and Taxpayer Information System. It is a comprehensive view of Form 26AS. I would say it is extension of AIR information. So with the help of AIR information, Form 26AS gets prepared, and AIS, TIS are comprehensive view of Form 26AS. AIS and TIS contain a lot of extra information which was not available earlier. It contains details of interest, dividend, mutual fund, foreign remittance, what is your GST turnover, and what not. Basically, the intention of the government is to link various departments together and collect the complete information about the assessees, so that the income tax return, first of all, is pre-filled. Secondly, the assessee don't, try to hide any income or escape from taxation. So that is the basic agenda behind AIS, TIS. Tax audit report is also one of the things which is to be considered, because when assessees are required to get their accounts audited as per 44AB, as in tax audit report, what is reported by the auditor has to match with their ITR form. If not, then again, problems take place. So I want to again emphasize that this is not a procedure. Filing of return of income, understanding the basics of law is very important, because correct filing is the key. Because of ITR forms, AIR, AIS, TIS, tax audit report, exchange of information across departments, government is already having a lot of information about the assessees. Getting PAN, Aadhaar linked, and mentioning mobile number everywhere which is linked with Aadhaar. So government is fetching a lot of information. If return is not properly filed, then what happens? Then assessments takes place, and assessments results into litigation. So the first type of assessment is processing of return under Section 143(1). Basically, CPC, Central Processing System, which is in Bangalore, which was set up in 2009. For bulk processing of returns, they process the returns in bulk, and the processing is machine reading processing. So machine, based on various informations available, they process the return of income of the assessee, and if there is difference of information anywhere, then adjustments are made in the income tax return. So say I declared income of ₹100, and because of various informations available with the department, they will say that no, your income is not ₹100, your income is ₹150. So when adjustments are made, we can either agree with them or we can dispute them. And for dispute, we'll have to go to litigation model. And trust me, friends, I am practicing litigation. The moment you enter into litigation, it's a never-ending process. There are various forums, appellate forums. First, you deal with assessing officer, then if not satisfied, you go to CIT appeal, ITAT, High Court, Supreme Court. So the case go on for like years. So it is better to rightly compute income today so as to save assessees or save oneself from future litigations which are never ending these days. So this was all from my side with regards to basics. This program of virtual direct tax series, this is designed in a very amazing way. We have created a background with regards to various things like what is income, what are the heads of income, what is the relevance of books of accounts, how a return is to be filed, TDS, processing. I've tried to cover a few important issues under income tax. I was allowed just 2 hours, and as per M2M, I have to conclude now. So this was a basic understanding which I thought one should have while starting the practice again or switching from industry to practice. Friends, income tax is a thing which is, updating every day, and it is never too late to get into the practice. It is not like that there are tycoons present under income tax who are having experience of lot many years. No, it is simple to understand, read, and move ahead with it. And I just hope that with this background which I have tried to set today, you all will be benefited and you all will be able to appreciate the specific provisions more in the upcoming sessions. So this was all from my side. I am open to questions, and I am just stopping my share of PPT. Over to Ragini ma'am now.
Thank you. You have been a lovely speaker and teacher as well. I believe all the participants have benefited a lot. You have taken us right from the ground level, the history of income tax, to all the nitty-gritties of residential status, types of returns, types of assessees. And we are really thankful to you for having explained it in such a beautiful way. Rather, there are a couple of requests I see for getting the PPT, because it is made with so much of sincerity. It may be of great help to our participants. So I would request the organizers to kindly arrange to share the PPT in whatever suitable manner it is possible. Though I do not see many questions here, there is one interesting question which says amount received on death by the legal heir from LIC is not taxable. If this amount does not reflect in the SFT, is one required to still disclose it as exempt income? If yes, how? And is it required to file the exempt certificate from LIC on the death claim amount which has been received?
So yeah, it is exempt, and as a tax consultant, I would suggest that it is required to be disclosed under income tax return, because maybe today or tomorrow they'll get to know because of so much sharing of information. So one need to disclose it in the income tax form only. And under section 10, there is a specific section provided for it. There, one should select and disclose the amount. With regards to filing of the proof, income tax today will not ask you for any proof. Only if the case is picked up for scrutiny, they will ask you for the proof, and then you'll have to provide it to the assessing officer. Because as on today, one cannot attach anything along with the ITR form. So yes, it is to be disclosed, and proof is required to be kept properly in the file so as to, be at ease in future.
I think that answers the question. And we also have some compliments for you, Shivangi. They say that you have already resolved some of the issues. You have given very good samadhan. So we are really proud of you and we are thankful to you. This comes from Mr. Om Prakash Agarwal in Kolkata. So thank you so much. I do not see many questions here. I think you have already put it in such a nice way that there's hardly anything to ask. We just need to learn and work more on it.
Just in case there are questions, I will request the organizers to collect question and I can, in person answer them in future if required.
So nice of you.
And the queries can be posted on the LinkedIn also. So I will be happy to help the fraternity and encourage all the women, new members who are coming into the practice. So thank you for that.
I think that's all from the audience side. And the learning has been really great. I put it up back to the organizers. Is there someone from the tech support team who can call the program off, or I can conclude with a vote of thanks? So, Shivangi, once again, though we cannot thank you enough, but on a formal note of vote of thanks, on behalf of ICAI, on behalf of the Women and Young Members Excellence Committee, and on behalf of Preeti Savla ma'am, all the team at WIMEC, and all the participants here who have learned from you, benefited from you, I thank you from all our heart. You have been an excellent teacher and faculty for teaching the basics, and I think everyone will be inspired and will excel slowly as we learn together. Thank you so much for being here. We expect to see you in more programs and to help us all learn together. Thank you so much. Thank you, audience, for being there. You have been a great audience. Thank you so much.